International Accounting Standard 2 on inventories. We're going to start off by doing a very high level summary, and I call this a standard on a page, a SOAP. So, IAS 2. We've crammed a lot onto one page, but it gives you a big picture, and it's a nice way to come back and do final revision. So, what is IAS 2 inventories all about? Well, it's about assets that are held for sale in the ordinary course of business, or are held in the process of production for such sales, or are assets that will be consumed in the production of goods or services that will be finally held for sale. So this excludes WIP, work in progress, under construction contracts. That is dealt with in International Accounting Standard 11, which is now being changed, but that's another story. Financial instruments, they have their own accounting standard, as well as biological assets. Those all have their own accounting standards and are not dealt with as part of IAS 2. So, we now understand what is inventory item, the measurement of inventory, that the common word here is lower of cost, or NRV, being the net realizable value. Okay, so we need to always consistently look at both the cost and the NRV and carry inventory at whichever is lowest. So costs will be all costs incurred to get the inventory into usable form, as well as the current location. Okay. Net realizable value is the estimated selling price in the ordinary course of business, less estimated costs of completion, as well as costs of selling. We will deal with each of these in a lot more detail in upcoming videos. Again, this is a very high level summary. Then, obviously, we need to go and look at this item being cost. So we will look at potentially using cost formulas, but first, let's understand different techniques of measuring costs for individual items. Here, if we are producing en masse, huge amounts of homogeneous product, right, then we'll need to have some type of approximation process or a cost allocation process. And here we'll look at, or the standards often talk about, either standard costing or the retail method. Standard costing, here we're going to set standards in terms of inputs, so we'll predefine what a standard input should be in terms of the quantity of material, the number of hours to complete that item, as well as the related costs. So we'll set these standards, which are all estimates and are set in advance of production. But this standard costing must approximate real cost, so we must continually assess this, right? Again, not really dealt with in huge detail in IAS 2. You'll need to go and do a course on standard costing. Excuse me. Then the retail method. The retail method takes the selling price of the items and assumes a constant markup percentage. And we can then say, well, the selling price or selling value of inventory is XYZ. Take out our standard markup percentage, and then we are left with the approximate cost of sales. Now, this can only be used in certain circumstances. Again, watch the future video on that. Then, let's look now at cost formulas. The two most common ones here that you need to understand are the weighted average formula and the first in, first out formula. We will deal with later on examples in future videos on this, but understand that there's two cost formulas that we'll look at. Okay, but we must use the same cost formula for all inventories that are of a similar nature and use. That's important. Okay, I can't choose, well, my inventories in the Johannesburg branch will be carried at weighted average, but the inventories in the New York branch will be carried on the FIFO basis. Can't happen like that. If it's similar items with similar nature and similar use, well, then I must use the same formula across the board. Also understand that inside of those cost formulas and the techniques for measuring cost, we have to understand that there will be conversion costs for a manufacturing enterprise. And this is where we take the raw material and we apply other indirect materials and labor, as well as overall overhead costs. to get to the cost of inventory. And here we'll talk about variable production overheads as well as fixed production overheads. The principle, however, is that you must exclude abnormal wastage because these fixed production overheads are going to be based on normal capacity. Okay, so a lot of information thrown at you, very big picture. You'll probably come back to this video after working through everything else to get a big picture once again and finalize your knowledge on IAS 2. We will deal with each of these areas in a lot more detail in the upcoming videos. Just a starting point for now. Thank you.